And we are live and we are back. Let's go. I'm Cory, your host, one half of the Quarter and Full Effect podcast, and I'm back like I never left with another installment of Wealth Wednesdays here on the Quarter and Full Effect podcast. We discuss health and wealth, finance and fitness, and everything in between. And we want to make sure you save more and say less and keep making better your best. Yes, yes. However, my co-host Jordan, who is back from paternity leave, but when he went to paternity leave, I started these Wealth Wednesdays where we get straight to the finance information. I think I'm almost 40 episodes in. This is 36, but I did some live streams and things like that. But I need to work on a better intro because I need to stop saying when Jordan on paternity leave, because why do I keep saying that? I need to work on that. But we get straight to the finance information here. No filler, no nothing. I know y'all see the title of that video. I mean, there's so many things going on right now. I was thinking, do I do student? I need to record more often because so much stuff is coming out because the student loan possible hearing, right? Rumors is coming out. They're going to rule against it. Surprise, surprise. We're going to talk about the mortgage rates increase, or is there an increase for those people with good credit? And there's just a bevy of other things that I have queued up that I need to discuss from just other things that I've seen. And on top of that, I have listener questions as well. So there's so many things that I have queued up, and I think I just need to record a couple and do multiple recordings in a day to get caught up. So I got a backlog right now. I feel like I'm doing at work with a Jira backlog, but we're going to get to the mortgage rates. Before we do, make sure that like button, share and subscribe for the YouTube algorithm. Make sure you leave those rate and reviews as well on the podcast platforms. You can follow me at silent_Cory. You can follow Jordan at Stop Stalling J, Twitter, Instagram, and TikTok for both of us. And then Jordan's business page is FinallyFit06 on Instagram and then FinallyFit on Facebook. Jordan is no longer doing in-person training sessions. I know he said that on the last Quarter Full Effect episode, but I want to make sure I say it again on this one if I haven't said it already. Now, the mortgage rate stuff. I mean, oh, also too, I know I was gonna say something. Y'all see, I got my bookcase finally set back up. Okay, and I was like, "Are you gonna?" My last apartment? It was more. They were straight directly behind me, and I was recording on my phone, so the camera was right in front of my face, and so you see directly behind me, and like you just see Dave like all the time right there. But now, since I have terrible posture when I sit in my seat, he's just always just peering over my shoulder, like just watching over me, making sure I give you guys good information. I guess I got a handful of books I gotta get to, as you can see, but it's been a crazy year. But now it's time for us to get into this mortgage rate increase information. Did the mortgage rates increase? I want to say this right now. I wish I had the soundboard. I've already said this before, but I mean, if you guys would follow the information that Jordan and I talk about on here, Jordan has a 15-year. I have a 15. Well, I'm going to get a 15. I don't have one, but when I get my house in the upcoming years, I have so much crazy stuff going on right now. I'm going to get a 15-year as well. And if you listen too much to social media, you won't properly get the correct information, which is why I recommend you all listen to us. And if you do listen to us, share it with other people. But yes, they're talking about these mortgage rates increasing for people with better credit, which is true. That is occurring. But they kind of left off a part. And I'm thinking, I think I know why they left off this part. And this is a big part, but we're going to get to that as we get to it. Today, y'all, we're going to Yahoo News. Let me see what this looks like because I don't share often on here. Dang, shout out to that ad. And again, before I get started, don't sue me, sue your mama. This is for entertainment purposes only. Neither myself nor Jordan are finance or fitness professionals. This is for entertainment purposes only. You need to do your own research for any and everything you hear on here and seek out a professional. All right, but now let's get started. Yahoo Life. I said Yahoo News, finance, whatever. Yahoo Life. Buyers with good credit will soon start paying higher mortgage rates. It says higher, not high. This is by Lindsay Thorpe and Jason Law. Okay, here we go, y'all. Let me see how this looks. Let's a little zoomed out. Let me zoom in one more time. I hate when this out. Love being on my phone. Okay, that looks a little bit better. 125, I think. Okay, whatever. Let me get started. Impending changes to federal rules on mortgage fees will mean higher credit scores no longer make for better mortgage rates. So in short, what they're going to do is they're going to make it so people are subprime, and subprime is a good thing, right? Shout out to Optimus Prime. He's the best type of prime. But prime means is a good thing, right? You're in your prime for people who do sports. Subprime means you're below prime, so it's not as good. All right, and if you think about the housing crash, 2007, 08, 09, A lot of subprime loans with that issue. You see a lot of cars getting repoed now. Those are going up subprime. So not good loans. They're not good loans. The bank views you at a higher risk. One way to know if you have a good loan or not is if there was a cosigner required. Whenever there was a cosigner required, it means the bank did not think that the primary or the person who isn't the cosigner, they didn't think they could pay back the loan. Because if a bank thinks they can pay back the loan, or a credit union, financial institution, they wouldn't require you to have a cosigner. All right, they're having a cosigner because like, they don't think you're gonna pay it back, but we're gonna give it to you if you can find somebody who will cosign, right? Who will also be liable for everything with this loan in case you don't pay, and their credit will get messed up if you don't pay. So essentially, it's both of y'all loans. Right? I mean, it may not be both of y'all assets, but the loan is both of y'all's. All right. And so what's happening in short is that, shout out to government subsidies, housing has gone due to the not due to the pandemic. Let's say it's the pandemic's fault, but since the pandemic, the cost of housing has skyrocketed, right? And then we had extremely low interest rates, and we had crazy high demand, so it made them go up out the wazoo. And now a lot of people in the middle class, and so by definition, all of the lower class, they're struggling to buy a home because the prices of them are just gone so high. So the government's come in. Shout out to the Biden administration. They have come in, and they are requiring people who have in certain credit scores or higher credit scores, or the highest credit scores in all honesty, and who put kind of more down. So people who have the high credit score and are going to avoid PMI, they are now going to have to pay higher rates, so that people who have lower credit scores and putting less down, subprime loans, have a better chance to afford the loan. And always remember, nobody explains to me why people who don't have money should get debt. If you don't qualify for the loan, why do we give you the loan? I know why, but still, like, my goodness, I don't know why people are so like, yeah, let's make sure people who are struggling financially have more payments, more debt for people who don't have money. I don't understand it. All right, but these changes are on the way. I believe they start May 1st. Today is April 25th. Yeah, I'm recording. Y'all can hear this on 26th. Right, and make better for no high credit scores make no better for mortgages. And the whole point of the credit score, in theory, is not so you can get more debt, but also have to pay a lower interest rate. Oh my goodness, is it fair? I don't necessarily think of it as being fair. Verna Brown said of the change, which takes effect May 1st. Like I said, Brown is a mortgage loan officer with Envy Mortgage in Franklin, Massachusetts. She says the industry has been gearing up for changes to federal rules on mortgage fees that will offer discounted rates for some home buyers with riskier credit. Riskier meaning low credit, not riskier low, the lowest type of credit. Credit score, I think, is 300 to 850, but for mortgage, I think you need to have at least a 640, something like that. In short, they're going to make it so that the people who have the lowest credit score, right, the people at the very bottom, have a higher chance of qualifying and being able to get a loan, which makes no sense. They're going to put people who are more likely to default and not be able to make their payments, put them in a worse situation. All right. They're redistributing the wealth, if you will, amongst the many to try and even the playing field for all the borrowers. Here's the issue. They're not redistributing the wealth. People, the top 1% are not impacted by this. This is a middle class. This is a change that's going to impact the middle class heavily. That's why we recommend y'all get your bag up. That's why I've been sort of saying like, all right, we're going to have to, you don't have to get the bag up, because this is, I don't know, this is not, you don't redistribute the wealth from the middle class to the lower class. You do it from the upper class down to the middle, down to the lower. You don't just start at the middle. The middle class is in the middle. Shout out to middle child syndrome. All right. In less than 2 weeks, right, mortgage fees, now it's a week, on home loans backed by Freddie Mac and Fannie Mae. So again, remember, in less than 2 weeks, mortgage fees on home loans backed by Freddie Mac and Fannie Mae. I talked about the 30 versus the 15. Maybe if you have a 15, right, you can avoid this. We'll see if that's true or not. But again, this says Fannie Mac and Freddie Mae. Shout out to my wife, who's a veteran. Shout out to the VA loan. So for those of you who are veterans or in the military and you're going to get out, DD 214, this is not going to, as of now, they can always change this stuff, but it's just Fannie Mac and Freddie Mae loans. VA loans are not that. So those should not be impacted by this. All right. But now they're saying their fees will jump for buyers with good credit. The former CEO of the Mortgage Bank Association, this is David Stevens, says this essentially subsidizes. Yes, it's a subsidy. Those with riskier credit. And this is why you should just do your research and understand the definitions of what people align themselves to. This is what Democrats do. This is what liberal slash Democrats, this is what they do. They're pro bigger government, pro more government subsidies. This is how they operate. There's no fans or buts about it. So you can't be mad when they do what they're quote unquote, they sign up to say, this is how I align myself. But this is what they do. All right, that's not a political statement. It's just how they operate from a policy standpoint. Here we go. Speaking of policy, it's a bad policy step. It lacks integrity. And that's not how we should be making housing policy right now. It should not include tinkering by regulation for their own, social political purposes at a time like this, Steven said. Yeah, I would say even if you were going to do this, now is not the time to do this with inflation at the wazoo. Like people are already struggling financially. The last thing you want to do is put them in a position where they can get more debt. You want to put them in a position where they can lower their debt. This is going to make it so people who can't get the mortgage and likely can't afford the payment, so now they can. All right, for example, this is saying a person with a 620 FICO score and a down payment of 5%, meaning they're going to pay interest on 95% of the loan for 30 years. That's insanity. Gets a 1 3/4 fee discount on a 30-year mortgage. But a person with a FICO score of 740 or above with 15 to 20% down, so 20% plus they're going to avoid this PMI, will see an increase of 75% in fees from the current levels. And this applies to people of all income levels, right? So again, it impacts the 1% of the wealthy by definition. There's no income threshold, but they're not going to deal with this, right? If you have a high credit score and 680 is a good credit, 680 is not a good credit score. 680 is not a good credit score. If you have a high credit score, 680 is a good credit score. This is one of the shout out to the lies. The lies. This 680 is not a good credit score. I would call that like it's probably I don't know what that. Let me see what the average credit score is. I was gonna say that average credit score is 698 or around 7. It's from 2021. So this is average, but this is like as far as like let's say the average grade in the class is a B, right? But average is a C. I would say this is the average was 680 to 700, but this is on like the low C range, high D range. If we were like give it a report card grade, 680 is not good. That's y'all get to the 680, you can get some debt, and you wonder where you're still struggling because your credit score is so right. 680 is a high credit score. You have to pay more, and we're talking about real money. What are we talking about? Fake money, monopoly money? This could be $100 a month more, $1,200 a year, depending on the size of your loan. So it makes no sense. Mitch Rochelle, Madison Ventures and managing director said, "Yeah, this is look. This is part of the Biden administration's push for affordable housing." A White House spokesperson said, "First-time home buyers will really benefit from this. This is not a good idea. This is not a good idea." Let me say this, and I mean this wholeheartedly. If you're in the high credit score 15 to 20% situation, you're just getting screwed. Tough luck. I would when I say deal with it, you can't change it. I mean, you can, right? I mean, you can change, policy. You can reach out to your your senator, your congressperson, whoever that is, on a federal standpoint. But at the end of the day, you just got to deal with these fees. These fees are coming. They're not going away. They're not high enough to the point where they should make or break whether or not you're going to qualify / get the house from a disbursement amount, how much you're going to qualify for from a mortgage standpoint. If it does, then you were already buying too much house. All right. Now, again, though, this is talking about 30 year. So, me, I like to come with the receipts because this is why I talk on the internet. This is why I need to come over here because now everybody's talking about this. All right. So this is for May 1st, 2023. Y'all probably cannot see that at all. I know you can't. It's a PDF. Let me zoom in one more again. I'm gonna leave right here. All right, so this is from May. This is going to start May 1st of this year. Okay, and as we scroll down, these are the rate changes. As we scroll down, what do we see this says? What do we see this says, y'all? This says applicable for all loans. That's a word I struggle to say. Applicable for all loans with terms greater than 15 years. Speaking of, can y'all let me stop sharing real quick. Yeah, y'all can see Dave in the back. Y'all can see Dave in the back. Shout out to the 15-year mortgage was recommended in that book. Totally Money Makeover. No sponsor. Fair use. But as you can see, that talks about saying if you have a 30-year, as I try to share my screen again and talk at the same time, but that's for all loans above a 30-year. So if you get a 15-year, like you've always heard us recommend on here, this does not impact you at all. Now, obviously, they can make a change and make it so it impacts all mortgages, right? But as of right now, this is not going to impact people with a 15-year. And we have to have a conversation about that. Should you get the 15-year or the 30? Now, we were telling y'all to get the 15-year before this popped up. Now, you probably definitely should get the 15-year. The main reason you should get the 15-year is, one, you want to pay off your house faster than 15 years anyway. I know on average, I think most people stay in a home 10 years. Let me see. 6 to 10 years. Ooh. Right, 47% is 6 to 10 years, 35% have lived in their homes for 10 to 15 years, 16% have lived in their homes less than 5 years. All right, that's from the Zebra. Who's the Zebra? All right, but I mean, if y'all want to pay these extra fees, cool. Now we can talk about how much you should put down to avoid PMI. It is your first home. People are usually more lenient. No issue with not putting 20% down to avoid PMI for your very first home. But my goodness, shout out to the 15-year coming in clutch, so y'all don't have to pay these fee increases. Now, if I go back real quick to this formula, just so you guys can see, because I have the table up that'll show what the rates are, the old rates were before this change. So again, someone who had a 620 FICO score, saying right here, right, and their down payment's from 5%, they get a 1 3/4 fee discount on a 30-year. So that again is saying a 620. So if I come here and I share this tab again, because I'm doing so much. All right, so 620 is going to be this very bottom row. My goodness, 639. I want to be clear. This classes, I would say this. I would say anything. If your credit score does not start with a 7, it's low. But I would say anything. Let's just do this. By the way, 780 is actually the high. 780 and above is when you're at an A rating. But if we go, A for 780, B for 760 to 779, and then C for 740 to 759, then D for 720. I mean, my goodness. I mean, anything. I would say you got to have, it offsets. The more you're putting down, the lower your credit score can be, because you're less of a risk, because the bank's giving you less money. That's just how that works. The more you put down, the less of a risk you are. But I would say if you're putting down less than 5%, that 3.5%, 5% range for FHA, you got to be in the 740 range. What's the minimum credit score? Look at Jesus Christ. The minimum credit score to qualify for an FHA loan is 580 with a down payment of 3.5%. How do you even get a 580 credit score? Your debt to income ratio needs to be 43% or less. The chances that your debt to income ratio is less than 43% and your credit score is around 580, less than 600, this has got to be borderline impossible. Whatever. This is why I'm not in charge. Then I guess people would be stifled and would be able to thrive. Whatever. Opinions are just that, opinions. Okay, what you're seeing here again, it was saying this very bottom row. So I think they said a 620. Look at that again. Yeah, 620, this very bottom row, as I'm wrapping up. And then they're saying they put 5% down, right? So 95%, they're doing 1.75, which is 3, right? I said 3 3/4, right? Math, right? 3/4 is 75%. But then they're saying if you have a person with a FICO score, as I switch the screen again, a 740 and above with 15 to 20% down, we'll see a 75% increase in fees. Now, these percentages aren't, like 75%, it's 0.75% technically, but, it's technically 0.075% because the 1% or the 1 is like out of a thousandth type of percentile, as y'all saw on this screen. Right here, we see like this 1.75, right? So 1 3/4. So it's a 0.75%, I believe, with a 75% increase. So again, this is someone here. I think it's at 740. So here we go with 740 on this row, and they're putting down anywhere from 10 to 15, right? So we're seeing this here, 1%, right? So this is what the fees are gonna start right now, or should I say May 1st and after of 2023. But if we go to last year's, or not last year's technically, but the one previous, if I zoom in again, are going to see here that this matrix is effective for all whole loans purchased before May 1st, 2023. So these are the previous numbers. All right, and we scroll down here. Again, what are we going to see? Applicable for all loans with terms greater than 15 years. So again, this was always impacting only the 30 years, the 15 or more than 15, so the 30 years, right? And again, we're going to see this person 720. And look at this, y'all. Look how they if I was, I wasn't gonna get a 30 year, but if there was ever another reason not to get a 30 year, look at this. Do y'all see this? Remember, this was 740 and above. Now they're changing it to where there's actually a 740 to 7. Goodness gracious. They got 219 point credit score ranges. It used to be 740 and above was the highest. Now they got 740, 759, 76. This is, oh my goodness. Shout out if you got 780 and above. But the old one was if you have a 740 or greater than or equal to 740. So I'm going to highlight again. You put 15 to 20% down, then within a range right here, you see it's 0.25. So they had that 75% increase. That's why you saw a 1% on the previous slide. So that's that increase right there. All right, if we look at the what people who have a 760 and above are going to pay, so this row and higher, they're still paying it. So if you had a 780, right? So if you had the highest quote unquote credit score, right, 800 plus range, instead of you paying 0.25%, you're going to be now paying 0.375%, which is a 0.125 or 1/8% increase. I believe that's an eighth. It is. It's an 8. You're paying an increase of 1/8. Okay. So that's just, oh my goodness. That's just stuff to think about, y'all. As I wrap up with the mortgage rates increasing, shout out to the 15 year. The 15 year is not impacted by this. And if clickbait, shout out to people. I know it's short form content, but at the end of the day, you're responsible for the content that you decide to put out. Not what people chop up, but what you put out. And if you're seeing people put out that these mortgage rates are increasing, but don't say, hey, if you get a 15 year, they're not. That's probably because they tell you to get a 30 year. See, how can I talk? Now, you should change your mind if new information comes out like this, a whole change from a policy standpoint from the Biden administration. But if you've been out here recommending a 30 year, what now you still going to do with all this increases from a fee standpoint? All right. And we dabbled on the 40 year on here, but 40 year mortgages aren't quote unquote out yet. You're able to refinance to a 40 year, which is why I really didn't talk about it. You can refinance to a 40 year. By the way, people, shout out to the people who are struggling financially. The Democrats, the Biden administration is coming through. They're making it so that for the 40 year, if you're struggling financially, struggling to make your mortgage payments, you can refinance to a 40 year. My goodness. And then they're also going to make it for those of you trying to get a home and you're subprime as well. So you're more likely to be in a situation where you need to refinance to a 40 year. They might as well just give these people, they might as well just get the people with 700 and under. They just might as well always start out people with a under 700 credit score. So 699, less than or equal to 699. Just automatically give them a 40 year. Let's just bite the bullet now so we can move on with this part of the conversation from an economic standpoint instead of just slowly. Just give it to them. Just start everybody out. Bump it. No more FHA, nothing like that. If you're buying first time home buyer and you only have 3.5% to 5% to put down and your credit score is less than 700, we give you a 40 year mortgage. And let's just say put the interest rate at 5.5%. Let's put it, somewhere around there because interest rate fluctuate a lot for mortgages over the years. Let's just put it right there. Give you anywhere from a 5 to 6%, right, based on your credit score. And if you put less than 10% down, your credit score is less than 700, you're going to get a 40 year at 5.5%. And so we can move on. So we can see how that plays out. Because now it's getting to the point where now, for those of us who are doing what we can financially to improve our financial situations, for those of you who do use credit, the main reason people want to have a high credit score is for the mortgage, right? It's for the mortgage. And then you also save up money, 15, 20% or more than 20% to avoid PMI. And now you get hammered on both sides. Not only and by the way, it is credit score is what it is. But if you avoid PMI on your first home and you didn't inherit any money, you save that up, work for it. Oh my goodness. With the average home, I think median home price in the United States is $428,000. So let's just call it $400,000. 20% of that is 80 racks. Who has $80,000 saved up? That's saving more than $6,000 a month if you save it up in a year. 6 times 12, 72. That's crazy. That's crazy. So if you're in a situation where I would say the credit score isn't that big of a deal. It's the fact that they're doing people who have 15 to 20%. If they were doing the same thing where people were putting, less than 10%, 3.5 to 5% down with a high credit score, 740 and above, okay. But you telling me I'm avoiding PMI and I'm still getting screwed? That's crazy. That's crazy. If it was something where they said, regardless of what your credit score is, if you're going to have PMI, you're going to have mortgage insurance on it, then okay. I'd be like, all right, I mean, you're already paying the PMI anyway. So it's like, okay, what's a quote unquote another fee? But if I'm avoiding PMI and you're still hearing me, that's crazy. And then obviously the banks, they're doing it because they're going to make, they make more money with this. But my goodness. But all right, y'all, locked and loaded. End of the episode. Shout out to the 15-year mortgage. First time buying a home, not as big of a deal if you avoid PMI. However, second place is only good when you're buying home. Shout out to King Los. I think he was Swag Boy Los at the time. But once you buy your second house and beyond, you want to start avoiding PMI on that. Your first house, 3.5, 5, 10%, whatever it is to get in there. Understood. Not going to fight with you on that. Put as much down as you can. But once you get your second home and beyond, always got to be putting 20% down. Got to be avoiding that PMI. And let me not say 20% because they can just change the rules as we see it. They can just change these rules. But all right, y'all. Remember that like button. We see y'all hitting that like button. We see y'all getting the views up. I don't know. I can't verify if y'all sharing or not, but we do see the views. We see y'all interacting. We appreciate it. If you have any comments, questions, or concerns, leave me a comment. Leave us a comment? Do you think that you should still get a 30-year with these changes? Are these changes fair or not? From a political standpoint, this is going to impact how you vote next year. Remember, we vote for a president next year. When we vote for a president was about to be May. So that's 6 months. 18. We about to vote for a president in 18 months. In less than 2 years, we may have a new president. As time moves very quick, and pandemic has been 3 years, right? I mean, time is moving so fast. All right. But leave any comments, questions, concerns on the video. DM us any questions, concerns you have, any topics you want us to talk us about, and obviously leave those rating reviews on the podcast platforms. Again, I'm _Cory. Twitter, Instagram, and TikTok. And my co-host Jordan can be found on those same places at Stop Stalling J, and his business page is FinallyFit on those same platforms except TikTok. And then he is, FinallyFit on Facebook, FinallyFit06 on Twitter and Instagram. No, he's just on Instagram. My goodness. FinallyFit06 on Instagram, FinallyFit on Facebook. There we go. Stop Stalling J, Twitter, Instagram, and TikTok. There we go. Then FinallyFit.live to sign up for virtual training sessions, 5:30 a.m. on Monday and Wednesday, 6 a.m. on Tuesday and Thursday. Don't ask me why he's doing different times on those days. Oh, it's because the Tuesday and Thursday are shorter classes. They're not as long because those are easier classes, right? For easier beginners. I was like, there's a reason for that. Monday and Wednesday is more intermediate advanced because those classes are longer. But all right, y'all, as I wrap up, please, inflation is crazy. Times are changing, right? With the Fed now stuff. There's so much stuff going on right now. And the one thing you can do to at least put yourself in the best position as possible is get on your budget and seize that payments, investments, lifestyle. I've already said this before. Do everything you can to increase your income. Highly recommend if you haven't really sat down and made some sacrifices in your life for, I would say, anywhere from 2 to 5 years, you need to do that immediately. It's going to come back to bite you. All right, y'all. Again, I think I'm going to try to upload / record a little bit more because I gotta get caught up. There's so many, like two, 3 things. Fed now, the 40-year, all this stuff is like happening in the last month or so. So I'm like, let me get caught up on some stuff. So you might see some extra videos out. It won't be like a permanent thing, but I might start dropping just a couple more videos to get myself caught up so I'm not still behind doing old articles. But all right, y'all, again. Remember to save more and say less. Keep making better your best. And I'll catch y'all in the next one.